Welcome to another video in Swing Trading Strategies video series. In this video, we will be learning about volume profile trading strategy. By the time you finish this video, you will have learned how to use this simple volume profile trading strategy and how to spot such big swings in the market and to time your trades to perfection with well-defined entry, exit, and stop loss. I have covered swing trading in great depth, and in case you have landed directly on this video, do watch the remaining parts of Swing Trading Strategy series. Link to all these videos is given in the description box below and will come up at top end of your screen. So before we get started, let me take up 30 seconds to explain what volume profile is. If you don't know how to get volume profile charts, just leave me a comment below and I will let you know some resources for the same. So traditionally, volume has been plotted on the horizontal axis to study impact of volume on market. However, you can also plot volume study on a vertical y-axis, in which case you are analyzing the total trading activity based on the various price levels. This is what volume profile is all about. It's a histogram of stocks bought and sold at specific price levels as opposed to specific times. Now, I won't be covering various types of profiles as this is beyond the scope of this video. I will be doing a separate series on volume profile and I will cover these concepts in that series. For this particular video, there are three main concepts you need to understand. Number one, point of control. Number two, high and low volume node. And number three, value area of profile. So let me first begin with point of control. So point of control actually refers to the area in the chart with the most traded volume activity. This is by far the most relevant area you want to monitor, as it can help to define the placement of your stops or the areas in the chart where you find entry levels. The highest concentrated area of volume for a particular time frame, we will call it POC or point of control, and you will be surprised how many times it acts as support or resistance on a retest. Now, traders do tend to use this as an area of support and resistance. For this particular strategy, I will come to the implication of point of control when I discuss entry and exit. So value area is the region where maximum trading activity has happened for the specified time period. In any form of trading, be it short-term, swing, or positional, taking note of value area regions is of immense importance. Now, most of the time you will see price moving with momentum once it moves below or above the value area regions. However, you have to keep one thing in mind, that not all value area regions are equal, and hence traders should identify prominent value areas and then trade based on this. I will come to this aspect once I discuss about entry and exit. For now, you have to only remember one thing, that value area is the region where 70% of trading activity has happened, or rather 70% of volume exists in this area. So let me now come to the concept of high volume node and low volume node. High volume node represents areas on profile where heavy trading activity took place between buyers and sellers, and generally this will be a price level or a region where market gets stuck around and a range usually forms. Now, price moves into and out of these areas are slower as market digests the trading volume and the demand and supply created by traders. This typically marks a consolidation phase in the market, and from swing trading perspective, this area helps you define strong area of support and resistance in market. It also forms the basis of entry and exit based on this strategy that we will be covering in later slides. Now, low volume node represent areas on profile where little trading activity took place between buyers and sellers, and this will be generally a price level or a zone that gets quickly rejected by traders. Trading in the area of low volume node, as I've shown here, can be very fast and aggressive, as price usually tests the level and then passes through or gets rejected. Now, you have to remember one thing, that high volume node and low volume node represent break-even points for longer time frame traders, and this is the main reason why these levels work so well in market. On a chart, always take note of high volume and low volume node regions. By knowing this, you would know whether the market is consolidating or gearing up for a swing move in days to come. So let me now come to a very important concept of price transition. So price transition happens from a high volume node to a low volume node, where either price consolidates and forms another high volume node, or it reverts back to the original previous high volume node. Let me explain this concept on chart. So in the chart in front of you, high volume node is clearly visible as price spends substantial amount of time in this region. Now once price moves above this high volume node and rallies on the upside, either price will start forming one more high volume node or it will return back to the current high volume node. It is this swing that we intend to capture using concepts of volume profile. That is the swing that happens from this particular region to another high volume node. Let us now see what price does as it moves higher in this particular case. So in this chart in front of you, you can see that price has transitioned from a high volume node region to a low volume node region. Price then forms a range and in turn forms another high volume node region here. Now this is how it plays out in most swing cycles. Once price moves out of a high volume node, it more often than not forms another high volume node or it reverts back to the high volume node it broke out from. This is the life cycle of price with respect to movement around volume nodes in swing trading. Understanding this is important as it forms the basis of how trades will be taken and exited. So let us now move to the entry, exit and stop loss section for this swing trading strategy. So in order to trade this strategy successfully, there are just two main criteria that need to be fulfilled. Number one, you need to identify a volume skew on the chart. That is, high volume node should be clear and prominent. And number two, at least 30 days of trading activity should be considered for this high volume node region. Now, once these two conditions are met, you then need to wait for price to decisively move above the high volume node region, that is above the point of control and value area of high volume node. Now let me show this to you on the chart and explain the entry method for this strategy. Now once the two criteria are fulfilled for number of days and high volume node, you then need to wait for price to move beyond this region in a decisive manner. Keep in mind one thing, that the volume skew that you see on this chart is not a certainty, and at times even after a 30-day period interval, volume would be all over the place without a notable skew. Once you have identified the skew, begin analyzing price action as price makes an attempt to move above this high volume node region. If you look at the chart in front of you, all candles above the high volume node region are wide range, strong bullish candles. If you spot weak candles, do not enter the trade. Always demand sign of strength from market when seeking entry for this particular trading strategy. Strong candles actually signal the presence of strong players in the market, and this would further increase odds of trade doing well. So let me now show you how stop loss is set in this strategy. Essentially, there are two ways that stops can be set. Number one, you can use this low point around the high volume node as stop loss and then ride the trend on the upside. This, however, is an aggressive way of setting stop, and this does get triggered many a times. A more conservative way of setting a stop loss in this strategy is to use the most recent swing low. This would actually give enough room for price to fluctuate and then still move up. Always remember that stop loss is to be set in such a way that price accounts for the underlying volatility in the instrument. If stop is too near, it would get triggered without altering the structure of trend. Do not forget this aspect. So let me now show you how to exit trade based on this method. Once price has had a breakout above the high volume node region, price will auction higher as I've shown on the chart. Whenever price is auctioning higher, do not think about exiting the trade immediately. If price moves up 15 to 20% from breakout level, then yes, you can exit your trade by reducing your position size by 50%. Else, you will have to wait for a volume node to develop. If you look at this chart in front of you, price has auctioned higher, but there is no sign of a high volume node yet. So let me explain how you have to handle such situations. For now, just keep this particular chart in mind. So once price moved up, there was no sign of a volume node being formed on the last slide. So what happens here is that price begins to move sideways and consolidate, and then we get to see process of high volume node being formed. Now once I spot this happening, I then place a stop below the most recent pivot point. Now if trend is strong, you will see this range getting resolved and price again moving higher. In case trend is not that strong, this trailing stop would be triggered and then trade would end in profit. I hope this particular segment is clear. So let me explain one more important concept. So before taking a trade, always see where the next high volume node already exists. So if you want to take a trade with price moving above the current high volume node and you spot that one more high volume node exists just 2 to 3% away, then let this trade pass. You need to make sure that there is no other high volume node near your current breakout region. This would actually increase odds of success. So let me now explain about risk management, since we have seen how to enter, how to exit, and how to place stop loss in this particular strategy. So most of the concepts that I've discussed here are explained by James Dalton, and all credit goes to him. Do watch out videos by James Dalton on YouTube. You will learn a great deal about market profile and volume profile. So let me now come to the risk management segment. The most important aspect that you have to consider initially while position sizing is to learn how to keep your risk constant. This means your entry price, your stop loss, along with the risk per trade would determine your position size level. So let me explain this with an example. If your entry price is rupees 100 and stop loss is rupees 190 and the risk per trade that you decide is rupees 5,000, then position size would be calculated as risk per trade divided by the difference of buy price, that is entry price, and stop loss. So your position size in this case would be 5,000 divided by difference between entry price and stop loss, which is 10, and hence your quantity would be 500. Always remember one thing, that initially your total risk per trade should be 1% of your trading account. Now, as you practice this more, you can experiment with position sizing techniques. If you indeed choose this strategy, then increase risk with time and experience. This is the best way to learn any method. So kindly consider hitting the like button and sharing this video as well if you like the content. So thanks a lot for watching this video, guys. Have a great weekend. Take care and be safe.